Welcome. My name is Jelena Ogilvie with Principal Wealth Partners, and I'm excited to host our first webcast. And this is an update on the equity markets. Let's talk about what we've experienced so far this year. It started incredibly strong up until February 19th. The S&P, over a historic 11-year bull market, had a cumulative return of 401%, as you can see from this first slide. If you reinvested your dividends, it actually reached 529%. That's an average return of 18.3% per year, unprecedented. And then we took a turn as the spread of COVID-19 created uncertainty and global markets came to a complete halt. We entered what's called a bear market as the S&P dropped 34%, oil prices collapsed, and government bond yields dropped to their lowest levels ever. The surprise to many was not the drop itself, but how quickly it came. Normally, it takes about 8 months for the markets to go down 30%. This happened in just 1 month. And then we saw some recovery. In fact, today we are about halfway back off these lows, and April was the best monthly return in over 30 years. This is a result of aggressive monetary and fiscal policy that's taken place over the last couple of months that I will discuss in more detail in our economic update. There are two considerations to make when you hear the media discuss the return of the equity markets. First, although the S&P is one of the largest and most regarded benchmarks in the US, it doesn't always paint the entire picture. The S&P through May 1st, with the drawdown and recovery, is down 11.8% year to date, as we note in the upper middle box. However, you'll notice that mid and small companies below it struggled far worse. Most notably, small cap value companies are still down over 30%. It's common in an environment with such uncertainty that the larger, more stable companies will perform better than the ones with smaller market capitalizations. You'll also notice companies defined as value on the left-hand side struggled more than companies defined as growth, which are on the right. Large cap value companies are still down 21% versus their growth peers, now down only 4%. The value side has been hurt most by oil companies down almost 40%, followed by financials down almost 30%, and industrials still over 20%. On the other hand, sectors like technology, which make up 40% of the growth side, are down only about 3%. We all see in our day-to-day lives the impact of COVID-19 on each of these businesses and sectors. This will continue to play out. The second consideration as it pertains to the equity markets is the S&P index itself. While the benchmark is considered one of the broadest of the US markets because it includes 500 companies, it has very narrow breadth as it relates to the market today. The S&P by definition is a market capitalization index, which means simply, the larger you are, the more impact you have. As you can see from this slide, there are 5 companies that account for more than 20% of its market cap today: Microsoft, Apple, Amazon, Alphabet, and Facebook. This means that a small group of stocks are driving up the market while the majority still struggle. In fact, Goldman Sachs recently commented that as the index recovered half of its previous losses from earlier this year, the median stock is still 28% below its high. We've also experienced a breathtaking change in our lifestyle with social distancing. We've seen firsthand the impact on our local communities, family, friends, and neighbors who have lost their job, are furloughed, or just can't go to work. Here we show the impact of this by the 5 most influenced sectors to COVID-19. Hotel and tourism in purple, airline and cruises in green, entertainment in dark blue, restaurant and bars in gray, and retail ex food and beverage in light blue. There are 3 ways to think about this impact. These 5 sectors make up first, on the upper left-hand side of the page, 19% of our economy as we define it by GDP. Second, on the bottom left, 20% of our employment. But third, on the right, only 7% of our corporate earnings. This effect of social distancing will be far more impactful from an economic perspective than from a corporate earnings standpoint. This is important to keep in mind as we are in the midst of earnings season. We expect earnings for the first quarter to be down double digits and for this to continue through 2020. However, corporate profits are likely to bounce back towards the end of this year into next year. So how does market volatility relate to recessions? If you look at this slide, you will note 13 bear markets as indicated by the diamonds at the top of the page since the 1900s. This is defined as a 20% correction, which you'll see from Diamond 13 is what we entered in February of this year. What's interesting is the average correction is not down 20% by its definition, but down 42% over these 13 bear markets, which is indicated at the bottom of the page. There are two things to note. The first is that these corrections are not always correlated to a recession. We highlight these recessions on the page with the gray bars at the top. Some recessions occur before a market correction and others are after. We must remind ourselves this as the media talks more about the economy heading into a recession. The second is the short-term opportunity coming out of a bear market. In fact, the average bull market is not up 20% on average, but 166% cumulative over an average of 54 months. So the average recovery tends to be almost 3 times as the return and twice as long in length. We may or may not have hit the bottom. There are still a lot of uncertainties, especially with such an unknown occurrence that we are experiencing. But that's why we diversify, and that's why we have a plan. If you're working with Principal Wealth Partners, we have your portfolios diversified and have not only been prepared for some type of correction, but have already been reallocating your portfolios through this entire process. This slide highlights the concept of diversification. Each color represents an asset class that you can invest in, such as the S&P in green and traditional bonds in light blue. The best performer for each calendar year is at the top of the page versus the worst at the bottom. There is no pattern to the return of these asset classes each year, except for the fact that very often the best performing asset classes, such as emerging markets in light purple, tend to also be the worst performing. Take note of 2017 and 18 as an example. This makes for a very emotional ride. And then we highlight the white box, which represents a piece of all of these asset classes. This example is roughly 60% in global stocks, 40% in global bonds and cash. The analogy that I would use is to imagine an anxious driver going over a bridge, say the GWB. If someone was to tell them that there are no guardrails on this bridge, where do you think they would drive? Probably as straight down the middle as they could. That is the idea of diversification. Notice that white box is never the winner in any given year, but it's also never the loser. It's meant to take the anxiety away. Everyone has a different white box of what that combination should look like, but this is the core of how Principal Wealth Partners looks at portfolios for their clients. In summary, the first quarter was volatile, in fact, unprecedented in its speed and recovery. We don't expect the volatility to end just yet, but we're laser focused on opportunities that have come from this. And not just in the equity markets, stay tuned for our upcoming economic and fixed income updates. Any questions, please reach out to any of us at Principal Wealth Partners. We're here for you, and thank you for listening.